Hey, welcome back to The Dive. The February Consumer Price Index, rate hikes impacting inflation, nickel, gold, and attractive junior gold companies at this stage of the gold market are the topics that our guest will deep dive into today. He is the founder and editor of Junior Mining Junkie. David Erfle is joining us today. But before we bring you David's interview, do me one quick favor and go ahead and smash subscribe, please. Hey, David, welcome back to The Dive.
Thanks a lot. Thanks for having me. Always nice to talk to you.
Yeah, thank you so much for joining us again. Okay, so let's start off with the Consumer Price Index. It increased 7.9% in February, marking the fastest annual jump since 1982. Do you think that inflation is likely to remain on the higher side for a while?
Unfortunately, yes. I just filled up my tank here in California and paid over $6 a gallon. I don't see it slowing down. I mean, if you take into if you take into account how the CPI used to be calculated, they've hedonically adjusted it since the 80s. The real inflation rate is probably around 17 or 18% right now. You've seen commodities across the board going parabolic because of what's going on over in Ukraine. So I'm concerned more about stagflation coming in here because the Biden statistics themselves have come out and they expect GDP growth to slow down. At the same time, we have rising inflation. When you've got a slowing economy and rising inflation, that equals stagflation. And the last time we had stagflation in the 70s, I remember it well. The gold price, when Nixon took us off the gold standard, was $35 an ounce at a fixed rate. And then by the time Paul Volcker was done raising rates to 20%, the gold price hit $850 an ounce. So I think we're in for a very volatile ride here in the gold price.
With the yield curve flattening, record high inflation, slowing growth forecasts, and the March FOMC meeting around the corner, how much action are you expecting from the Fed?
Oh, yeah. An inverted yield curve signifies recession. I mean, the Fed has yet to even begin raising rates, and the yield curve's already almost inverted. So when yield curve inverts, they usually increase monetary policy. Now that they're about to raise rates for the first time since 2018, we've already got skyrocketing inflation. And the U.S. debt now is over 30 trillion, and global debt is over 300 trillion. So when the Fed was able to raise rates back in the 70s to stop inflation, the debt was only 900 billion. So that gave them the foresight to go ahead and raise interest rates to a draconian level. Now they're even concerned about raising a half a point. Powell, in testimony in Congress last week, basically admitted that, hey, we got it wrong. We're behind the curve, but we're only going to raise rates a quarter of a point because we don't want to upset the markets.
Do you think a rate hike will have an impact on inflation?
I don't see how. I don't even see how they can raise rates very much because the national debt of over 30 trillion. 70% of that national debt is cumulative interest rates. The interest payments on that debt is huge. So, and then you got the European Central Bank coming out today and basically saying the same thing. Their growth is slowing, and when the ECB talks hawkish, they're just talking about taking away stimulus. They're not even considering raising rates. They've had negative interest rates since 2014. They've completely destroyed their bond market. The European Central Bank is buying the debt. So, central banks are in a very, very difficult predicament here. And the gold price is going to continue to rise as stagflation creeps in here.
So heading into the second quarter of 2022, the balance of the Federal Reserve's assets are almost $9 trillion. Members of the Federal Reserve are debating how quickly to reduce the central bank's portfolio of bonds. How likely do you think it is that we will see the Federal Reserve do any quantitative tightening?
I don't see how they can. with the stock market, the NASDAQ officially went into bear market territory this week. That's being down 20% since its peak. You've got the stock market, continuing to deleverage here. And if the Fed tightens too much with the yield curve already almost inverting, I don't see how they can be very aggressive on tightening monetary policy.
Mm-hmm. Okay, so let's move on and talk about nickel for a second. The London Metal Exchange was forced to halt all trading in its nickel futures last week to balance its books and restore market stability. Do you think the effects of nickel's jump on EV prices and sales could be significant over the next couple of years?
Oh, it's going to be the price jumps in all these commodities is going to be significant. I mean, if you take a look, there's three charts that people should take a look, long-term charts that people should take a look at right now, and that's the long-term chart of gold, the long-term chart of oil, and the long-term chart of copper. Copper is about to break out. It's been consolidating a huge move for a while. The last time it had a huge move, it went up threefold. It's been consolidating that huge move, and the oil price just blew through resistance at $112, $114. The WTIC price just blew through it last Friday and had a weekly close above 115. And then when the U.S. announced that they were going to stop buying Russian oil, the gold price ran to the WTIC price ran to $140 a barrel. I wouldn't be surprised to see oil at $200 a barrel by the end of the month, and the gold price close to $2,400. That wouldn't shock me with what's happening here. They're not doing too much to stop it. The sanctions that they're forcing on Russia, that the Western politicians are forcing on Russia, is rising, is continuing to rise, continuing to fuel the rise in commodity prices. I mean, 30% of wheat comes out of the Russian-Ukrainian area, and they're a huge impact on commodities. So yeah, it's going to be really interesting how this plays out. I'm all for the gold price going higher, and it's nice to be right about the gold price going higher, but the reasons why it's going higher, I'm not comfortable with, I'm not happy about, and neither should anybody else should be, because nobody benefits when there's a war. Everybody gets hurt, and it's the winners that come out are the ones that lose the least. So I'm very concerned about the world right now.
Mm-hmm. Yeah, there's talk the Biden administration is considering imposing sanctions on Russia's state-owned atomic energy company, Rosatom Corp, a major supplier of fuel and technology to power plants across the world. If imposed, what do you think this sanction means for U.S. nuclear plants and importers of fuel?
Oh yeah, I mean it's incredible. You've also got Germany saying that they're stopping nuclear power production, and at the same time, they're incredibly dependent on Russian gas. So what the U.S. is also doing, they've got a bill in the works right now that could be passed by Friday, is they're putting sanctions on their gold, because they're worried about Russia selling their gold to finance the war. So there's all these things are converging right now for the gold price to go much higher. And as far as what's going on with the Russian economy, I mean, it's completely imploded. Their currency completely imploded overnight last week. And once these Western countries took Russian banks off the SWIFT system, that's huge. That's basically literally waging financial war against Russia. So this is going to bring even more volatility, not only into the gold price, but into most major commodities.
How high do you think that the gold price can go, given all this recent action?
Oh, geez, if you take a look at this incredibly bullish cup and handle formation on the gold price that's formed over the past 12 years, the cup and handle formation in technical analysis is the most bullish formation. And the last time the gold price formed a long-term bullish cup and handle formation was from 1976 into mid 2005. And once it broke out of that cup and handle formation, the gold price went from 425 to over $700 in about 6 months. So this cup and handle formation, once the gold price has a monthly close above 2,100, will be complete. And I wouldn't be surprised to see the gold price hit $3,000 either by the end of the year or beginning of next year.
So our audience is typically small cap focused. What kind of junior gold companies do you think offer the most attractive risk reward profiles at this stage of the gold market?
Well, what I've been doing personally for myself and my subscribers is that I've been accumulating juniors that are de-risking high margin projects that contain multi-million ounces of gold. They're in the later stages of de-risking these projects. And if they have a management team that has access to capital and they're serially successful, they've done this before. These single asset juniors that are de-risking these projects, they're still very cheap. If you take a look at major mining companies and royalty companies, they've had huge moves while this has been going on with the gold price. Yet the juniors have yet to play catch up. And this is what happens after you have a major bottom after a few years of consolidation. The majors move first, the royalty plays start to move right after that, and then the mid-tier companies do, but the juniors don't start to move until after that, and in a short term after that. And once the GDXJ has a weekly close above 47, it hit 50 today. I think there's a really good chance that the GDXJ will close on a weekly basis above 47 this week. I expect that a lot of these sector professionals will start to rotate some of those minor profits into the juniors that are still very depressed and undervalued in relation to the gold price. There's a lot of these projects now, their base case that these juniors are using is $1,600 gold, and most of these projects now that are being de-risked are economic at these gold prices. So, I genuinely, it's historically speaking, this is what has taken place in this sector. And when the juniors start to run, they really start to move quickly.
Okay, so lastly, David, where can our viewers go to subscribe to know more about your trading activities?
Oh, sure. It's my website is juniorminerjunkie.com, and each Friday I have a column on Kitco that comes out each Friday.
Okay, perfect. Well, thank you so much for joining us today, David. It's been so nice to talk to you.
Absolutely. Nice talking to you as well.
Thanks so much for watching today. We'll be back again tomorrow, so be sure to hit that notification bell on your way out.